US ports shuttered, but the economy remains on solid footing. Welcome to Market Insight. I'm Peter Devlin. Long lines of container ships queued up outside major US ports on Thursday as the biggest dockworker strike in nearly half a century entered its third day. The National Retail Federation cautioned that the walkout could have devastating consequences for the economy. But will markets pay attention as data continues to be upbeat? Well, joining me now to talk about all that is Satyam Panday, Chief US Economist at S&P Global Ratings. Welcome, Satyam. So starting with the strike, and JP Morgan estimated that the walkout could cost the American economy roughly $5 billion a day. How long until we see any significant impact?
Well, I haven't seen their report, but I could say that the longer this goes on, the more of an impact in the overall economy, especially in the supply chain logistics. We have about a third of the traded goods and uh, coming through these ports as a share of the total imports and exports, and especially heading into the holiday season. I think this would be a challenging logistic issue for the retailers and other businesses if it goes on for a longer time. I think time is of the essence, a non-linear impact here. But we have seen that the inventory levels right now in the economy are pretty healthy. So maybe perhaps if this gets resolved within the next week or so, it may not have so much of an impact overall. But as time goes by, it'll start to show up in some shortages and some pricing points.
So turning now to economic data today, and we did see the services sector activity jumping to an over-a-year high, as boosted by new orders. So is there room for improvement?
Well, I think some of the data coming out of the services, it's a good reminder to all of us that the weakness in the manufacturing sector is not a systemic threat to the modern service-related economy in the US, right? Having said that, together with the services coming in, this morning, and some of those positive revisions that we saw last week in the personal income accounts for the households, the US economy, the consumers especially, are resilient more than what we had thought before. And at the same time, there's the data that is contrasting where the labor market, and even with this, the employment sub-index within the ISM service index that came out today, it shows actually a contraction. So it is a bit of a weird thing going on within the data front. So that is a red flag still within the scope of the data that we are seeing currently.
So again, just keeping with that moderation in the services employment index, what are your expectations for non-farm payrolls tomorrow?
Tomorrow, we are expecting 150,000 jobs gained for the month of September. Uh, Again, we have the unemployment rate that we think is going to be holding steady at about 4.2% for the month. The current issues with the ports are not going to show up in that data, obviously, because it doesn't fall in that month. But the Boeing-related strike, it's been going on for 4 weeks now. And then, that should be impacting some of the data. But overall, layoffs were low for the month, so we don't expect so much weakness in the employment data coming out tomorrow for the month of September.
So Satyam, you've said in your notes that you expect US real GDP growth to slow next year. Are you still saying this after stronger data today?
Well, the trajectory is one where it is going to slow down a bit from the levels that we are right now, from an above trend growth rate to a slightly below trend growth rate. The issue is with the timing of that slowdown, right? Now, given the revisions that came through, the historical revisions that shows a more resilient consumer, more savings in the consumer's balance sheet, that timing may be a little bit delayed than what we had thought initially.
So finally, Satyam, and if these potential strikes continue, stoppages at the ports will ripple across the labour markets, particularly warehousing and transport. So at a time when the Fed's easing cycle is highly dependent on the labour markets, could a prolonged strike prompt a 50 base point cut in November, or are you resolute in your 25 call?
This is all very much a data dependent territory right now. It really depends how long this goes on till. My guess is the Fed is probably going to look through this strike if it just turns out to be a short-term impact. Because these are folks who are getting furloughed. They're not really getting, there's about 40 to 50,000 people directly impacted in that particular industry. And then you've got the other services industry that actually caters to the port industry in the location. So altogether, there's somewhere close to 90 to 100,000 folks at risk here in their jobs. But a lot of it is going to be just a furlough where you're gone as long as the strike is going on, and then you sort of come back to your jobs after that. So the Fed might just look through it as a temporary issue. Again, if it keeps on going for a long time and if it starts to affect negatively the jobs and the GDP numbers of the economy, then yes, they might just be influenced by that and go with a 50 basis point, in fact. But again, it is all highly uncertain right now at the moment.
Satyam Panday of S&P Global Ratings. Thank you very much for your thoughts. And that's Market Insight. Don't forget you can watch more videos on Reuters.com.